Good afternoon and good morning to those joining us today from the US. My name is Tony Reid. I'm the EMEA Chair of Squire, Patton, Boggs corporate team. I'm delighted to be your host today for the 8th in our series of Talk to the Experts at virtual discussion forums. Just a few points on admin before we get underway. There is a chat function on the left-hand side of your screen, and so please feel free to raise questions during today's discussion. We'll try to reply to your questions during our session, but if we run out of time, we'll come back to you after the event. Today, we'll be discussing what organisations can be doing to deliver value by their approach to sustainability and climate change, and how investors recognise value in those approaches when making investment decisions. Matthew Kirk, our International Affairs Advisor, will chair today's discussion. Our panellists today are Sebastian, Director at Guidehouse, Kendrick, Corporate Partner at Squire, Patton, Boggs, Rawdon Rogers, Head of Sustainability at Yorkshire Water, and Michaela Seimen Howat, Sustainable Debt Strategist at UBS. Matthew, over to you.
Thank you very much, Tony, and thank you to our guests for joining us. So as Tony said, today is all about delivering value through sustainability, and what we want to try and do is explore the dimensions of that value. To maybe move away a bit from the notion that value is only delivered in purely financial terms, though obviously financial value is still extremely important in the market, as I'm sure our guests will explain. Let me start by turning to Gordon and ask you, Gordon, please, to tell us a bit about Yorkshire Water's approach to sustainability. Well, water is one of the most basic of all human resources, but also challenged by climate change and by the impact of what's happening in our ecosystem. How do we assure our future supply, and how organic is that sustainability to the way in which Yorkshire Water goes about its business?
Yeah, hi, thank you, Matthew. I think as a water company, as you say, because it's such a basic human good, and so critical to ecosystems generally, sustainability is absolutely central to a water utility. I often think we're at the forefront as a water utility of sustainability and resilience issues more generally, and climate change and changing weather generally is probably almost certainly our biggest issue by a long way, both whether we have too little water as we have longer dry spells, but equally whether we have too much water in increasingly extreme storm events and these kind of short, sharp downpours that we have. So there's kind of it's both a resilience and an adaptation dimension to climate change, and kind of somebody is going to be here providing water and wastewater services for future generations. So it's very much a long-term infrastructure resilience issue, and building that resilience, making sure we're not our key assets are not open to flooding, we have enough water resources for the future, we're preparing for rising sea levels, all those kind of issues. But equally, we're a huge energy consumer, we pour a lot of concrete, and so we do have a very large carbon footprint in ourselves as a company and as an industry, and therefore trying to show our leadership on reducing carbon and kind of minimising future climate change is absolutely critical to that. So to kind of pick that apart just a little bit, there's a really strong theme on how we all use water more wisely, both as a company, how we reduce our levels of leakage and we don't waste the water that we take, but equally how we work with customers, both domestically and with industry customers, to use water more efficiently and kind of drive behavioural change. And then equally how we design our assets and our infrastructure for this long term, and we're increasingly looking at very different designs of how, rather than pulling more and more concrete and trying to contain nature, but how do we more work with nature and kind of mimic and support nature to help us in all the services that it gives us, really. And then it's not just environmental either. I think there is that natural focus, and that is very paramount. But equally, there is a social and a financial development element to sustainability in the water sector, both from a kind of this balance of affordability for vulnerable customers who struggle to pay their water bills, balanced with making sure we have enough investment in that resilience and that future planning. And there is a balance and a trade-off to be had. And then equally, particularly for the UK water companies in England, we are this very unusual mix of a very public service but privately held, privately managed, and therefore we have this strong social element of legitimacy and trust to really give us that moral license to operate. So therefore being really open, transparent and inclusive is really critical as well. So it's quite a complex piece.
Thank you very much, Gordon. Sebastian, could I ask you perhaps, first of all, to introduce us to Guidehouse? And as you describe what you're doing, I think, how much do you sense that you're now going with the flow and pushing against an open door in terms of the kinds of services you offer?
Yeah, thank you for the question. Just 30 seconds on Guidehouse for those who don't know it. It's entirely possible. It's the largest management consultancy that you've never heard of. It's Washington-based, with pushing 5,000 people, covering healthcare and life sciences, financial services, and the team I'm in, energy. The energy team is approximately 750 people, which makes it one of the bigger ones. And inside the team, you've got specialists covering grid, all the way through to advisory of utilities, to working with Wall Street funds on placing investments into the next generation of energy infrastructure, and indeed also startups. So it's a thriving place to be. I started in sustainability back in 2002, and I think what was interesting then is when you started to talk about sustainability, everyone kind of assumed that you were working for an NGO. And it's really evolved in the last decade to the point where we really have really strong tools, which is of course what we're going to talk about today with regards to environmental, social, and governance factors, and really resilient frameworks that both corporates are coming to rely on, and investors are really focusing on in order to make better investment decisions. So, I guess one of the main themes that we're seeing today is the intersect between the investment community wanting to make better allocation decisions, and also to be a custodian of long-term investments that they have as well, to ensure that corporates are moving in the right direction. And at the same time, corporates who, especially in the environment we're in today, are thinking increasingly about the impact they're having on their customers, on their communities, on their shareholders, and the broader sort of stakeholder engagement piece. So, we're fortunate to be able to straddle both of those, and a lot of our time is spent helping investors really sort of unpack data and give it meaning, and simultaneously help corporates think about how do you build a resilient long-term business whilst recognizing and respecting all of the different stakeholders that you have to create and protect long-term value.
Thank you, Sebastian. You've set it up beautifully for me to turn now to Michaela, who of course comes from the investor community. Michaela, please tell us a bit about UBS's approach to sustainable investing, and particularly, is it within UBS seen as something distinct from regular investing or an aspect of regular investing?
That's an interesting question, and a topic highly discussed actually these days. So let me maybe give you a little anecdote on that. So I'm a rejoiner of UBS, and sustainable investing was already in focus in my previous job while I was working in the investment bank from 2007 to 2010. And one of my colleagues predicted back then that within a 10-year period, this sustainable investing, as we look at it today, would be the norm. And we would be all without jobs, as sustainable investing or ESG experts would not be needed, right? So we are not there yet. But if you pay attention to the annual reports and sustainability reports of banks and asset managers, sustainable investing represents actually already an essential part of today's business. So, and that is guided by client demand, regulation, and social responsibility. And also recalling just what Sebastian said, it's really like still a finding process for all participants in the market. So how does sustainable investing look like in practice? So first of all, I think it's important to point out that sustainable investing is not about just another product line. So in our view, or in my view particularly, because I come from the risk management environment, it's an investment philosophy. So broadly speaking, sustainable investing contains 3 distinct approaches. So it's an exclusion strategy, which most of you might know is the oldest form of sustainable investing. Then you have integration strategies and impact investing. And here at UBS Global Wealth Management, we focus on integration and impact investing. But overall, we need to keep in mind actually that although we were hoping more than 10 years ago that we would be much further ahead of the curve, but unfortunately a financial crisis came into the way, the market is still developing, and we are actually collaborating with partners to fill gaps in the sustainable investing landscape to provide innovative new solutions. Because if you look at the market, most of it is driven in the equity environment. But if you look at the fixed income environment, I'm particularly looking at, it's still developing. I mean, we have green bonds, a fantastic product, social bonds, now very popular in the COVID pandemic situation and will further develop. But then if you look at alternative parts like hedge funds or so, that's still developing.
Thank you very much, Michaela. Gordon, can I turn back to you and ask you to develop a little on the answer you gave to the first question, and particularly thinking of the E, S, and G of ESG, how separable, how compartmentalized can you be in your thinking about them? If, for example, you had a primary focus on the environmental aspect, and you talked about that in your first answer, would you be able to deliver on that on its own, or do you need to do it all together in order to be able to deliver on any element of ESG?
Yeah, I mean, the short answer is it is entirely inseparable because they're so interrelated, and really we're managing the environment to deliver a social imperative and social services. So it's all entirely one thing. And I guess in environment and a lot of the sustainability and climate change challenges, because we as a global society have been kind of going too freely at the environmental goods as if they were infinite, which of course they're not, and that's what we're trying to rebalance. So there is a turning up of the environmental and equally some of the social unfairnesses, kind of rebalancing those and bringing those as a stronger voice into the argument. But they are absolutely as one, and especially as a water utility, again, as I said before, kind of we're at the forefront of that because we have this very deep connection with society. We're one of few to touch every household, and equally with the environment, taking water and returning water every second of every day. You kind of have that very deep connection. But of course, it might be more complicated and more hidden for any other organisation, but it's no different. The fundamental reliance on the environment is there to some form or other. And therefore, really, as we've been touching on in those previous answers, this is ultimately a risk management and a value management exercise. And sustainability is way beyond where it was in the 1990s of a bit of greenwash and a tokenistic project to try and make somebody look good and maybe differentiate a little bit. It's far more integrated is the word that we increasingly use in my profession, and the integrated approach has increasing numbers of national and international frameworks and standards, and increasingly legislation actually driving and shaping good practice in this ESG space to make sure that all organisations are recognising that risk and value and managing it properly. And there's both internal and external dimensions to how you manage the data and bringing new environmental and social types of dimension to our kind of board reporting and the measures that they're following, and even to their executive remuneration now at Yorkshire Water. And then equally, sort of 5-6 years ago, I introduced an integrated reporting approach, an ESG approach, into our annual statutory accounts, so that it not only focuses on all the typical balance sheet and profit and loss position, but equally on pollution and climate change and carbon emissions and waste management and all these different dimensions. And then in practical terms, over the last year, that's moved forward again for us, and now linking back to those last answers, we've linked that back through to our kind of corporate finance approach with a sustainable finance framework. So virtually all the debt we now borrow is sustainability bonds, and locking us in again with our investor community to making sure that finance is targeted at environmentally and socially good outcomes, and having to report on it to show where that money has been invested and the impact that it's having. So increasingly it is core business, and certainly for me at Yorkshire Water, it's a pretty much daily board and leadership level discussion.
Thank you, Gordon. Sebastian, there are, I'm sure, and probably on the call, there are corporates who are less advanced and less comprehensive in their thinking about this than that Gordon has just described for Yorkshire Water. I wonder if you could say a word about how corporates should be thinking about developing an ESG program if they don't already have one, and particularly the balance between how much they need to think about this coming from within, building on corporate purpose, their values, and so forth, and how much is through developing a proper understanding of stakeholder perceptions and aspirations for corporate behavior.
Yeah, sure. It's really interesting. I think when we have our first meeting with clients on this subject, often the conversation actually starts with a discussion on a sustainability report or an ESG rating. And what we tend to do is we tend to wheel back and think of those sort of components really as outcomes of the process. You know, overall ESG is an ongoing process that affects an organization's decision-making process, really. And a single report or a single rating in itself is a window, but it's not really telling the story. So I'll give you an example. We were fortunate enough to work with a North American utility who had been approached by an activist investor who had taken a minority stake in the business. And the activist in this case had a very progressive focus on sustainability and was asking this particular utility, which was still very reliant on coal and oil for its generation, what it was going to do in the long term. How is it going to move to renewables? How is it going to engage in electric vehicles and everything that goes with that? And they realized at that point that what they really needed was support to really break down ESG and to help them build a process. So we started out with them engaging with a very broad array of stakeholders, both within the organization, within the communities, the universities, the NGOs. It's incredibly broad, to capture all of the potential risks and opportunities that perhaps they may or may not have on their dashboard. And ultimately, the goal is to begin to weigh those and to incorporate them into strategic planning and enterprise risk management, which, as I'm sure everyone on the call appreciates, is an ongoing process. That, you know, there'll be an annual review, there'll be a checkup, there'll be KPIs, there'll be perhaps a sort of some third-party support if things need nudging in the right direction. And all of that is geared around creating long-term sustainable value, which, you know, if you're a BlackRock or a Vanguard and you own 20% of the S&P 500, you're not looking at an ESG rating to decide if you want to buy or sell a business. You're taking a 20-year plus view, and therefore you want to see that the process they're delivering is giving you the confidence that you need in the management team to shepherd that business in the right direction.
Thank you very much, Sebastian. Michaela, just building on what Sebastian was saying there, and particularly the emphasis on the long term, there are some quite interesting statistics, for example, about the long-term performance of companies with strong boardroom diversity. But where can we look to find the financial value in ESG programs? And would it be right to think of it as a short-term cost for long-term value, or can you find short-term value in ESG performance as well?
Well, aspects of performance and risk management are critically important to all investors, right? So, and I think Sebastian just laid it out very nicely from a corporate perspective as well. So how we think about it is that sacrificing returns for positive social and environmental impact is not always necessary, or it's not necessary probably at all. And we should not confuse this with philanthropy, because I think there's still a lot of people around who do not understand that this is different, right? So my background is in risk management, and what investors need to consider is exactly what Sebastian said, right? That sustainably managed companies may experience actually competitive advantages. So also Gordon said it very nicely earlier from their company perspective. So what do I actually mean with that? So because if you have as a company less exposure to certain environmental, social, and governance risks, it means that the material impact on your financial performance is lower, right? So because if you have to pay out fines because of oil spills or social issues, etc., that's absolutely it's impacting your financial performance. And for me as an investor, this is obviously also an impact. Then you have, from a company perspective, also improve operational efficiency. And again, that was what's said both by Gordon and Sebastian early on. And this will lead to long-term cost savings, for example, energy efficiencies on the company side. And then also from a reputation risk point of view, and this is not only linked to better customer loyalty, but also there's an ability to better attract more intelligent, more better placed workforce talent, right? And this is all very important in today's environment. And actually, if we look at like a long-term historical performance of sustainable investing strategies, we actually find on an index level that basically they are performing in line or even better than conventional indices altogether. So it's not necessarily that investing sustainably does cause a drag on performance. And this goes in line with what the speaker said before.
Thank you, Michaela. And I particularly liked you drawing the distinction there between ESG, which is fundamentally about corporate behavior, and corporate philanthropy. To do corporate philanthropy, you only need money. To do corporate behavior, you need a whole series of the sorts of things that Sebastian was describing earlier. Hannah, could I turn to you and ask to what extent you think corporates can confidently showcase their ESG performance? What sort of levels of verification and audit should there be of claims that corporates make in this area? And what about the identification of ESG-related risks?
Thanks. I think for all of the reasons that we've heard from Sebastian, Gordon, and Michaela, I think we want corporates to be able to very confidently showcase their ESG performance, don't we? I mean, it's clear that if there's a good story to tell, in the same way that you'd celebrate good financial performance, you want to be sort of shouting out there and getting your ESG related performance out there too. And a few of the panelists have mentioned the increase in regulation, how we're moving towards that sort of disclosure level, whether it's about engaging with stakeholders, climate related disclosures and everything. And it's going to be calling for more detailed and extensive disclosures, which is inevitably going to lead to those disclosures being scrutinised, which means that we've got to sort of take extra steps to make sure that the information that's out there is verified, as you say. I mean, in terms of what companies are putting out there, again, as Sebastian has noticed, companies are sort of setting out their own KPIs. I think there's been a bit of discussion about whether there's a mismatch between the data being provided by customers and what investors need. And obviously, I think the one place where everybody's starting to align is that the information that corporates are putting out needs to be reliable as a first step. It needs to be sort of comparable, and it needs to be useful. It needs to be decision useful information. and we see that sort of flow through as well to what, again, picking up on what some of the speakers have said in terms of the way investors are using the metrics, the ESG metrics, to make their investment decisions. And of course, if that isn't reliable, if it's not verified and reliable information, you've got the obvious reputational risks if things go wrong or might be misleading or perhaps overstated. But I think more and more we're moving into a sort of an era where the risk of litigation of somebody taking those investment decisions on the back of your disclosures and then suffering a loss is going to be sort of is going to be increased. I think historically we've looked at the information that companies have put into perhaps sort of CSR sections of annual reports, and I know Gordon mentioned what they're doing at Yorkshire Water in terms of reporting, but we've moved to a new level with that. But historically there were some companies who were sort of perhaps didn't give those statements quite the focus that you might expect now, and that they might be sort of vague and aspirational and perhaps less reliable. In the US, there's been various pieces of litigation, and one of my favourite phrases is, sort of trying to work out the difference between something which is a material representation and something which is immaterial corporate puffing, which I think probably it's not that long ago that a lot of what we saw in sort of CSR statements fell into that latter category. I mean, in terms of that confidence and the risk, in the same way that an audit committee has its arms around the financials and the numbers, a board's got to have its arms around the ESG disclosures and how it's identifying the ESG risks. So, what should boards be doing to get themselves comfortable? Do you need a third party to kick the tyres on what you're disclosing and your risk identification exercise? And undoubtedly having the right third party involved is going to give the disclosures and your whole ESG program added credibility and reduce the risks going forward of the consequences of perhaps less considered disclosures.
Thank you, Hannah. And just building on that, Sebastian, could we talk a little bit about how corporates can actually show that they're measuring performance in this area? And it seems to me that there are a number of different frameworks out there. Do those competing frameworks make it harder, or are they all sort of pushing towards broadly the same standards in the end?
So that's a really interesting point. I'm sure for those who were around in the 80s and 90s, you'll remember video. And in the early days of video, there was this fantastic competition between VHS and Betamax. And the goal and the belief was there could only be one, which of course there was. With all the different standards that have developed over the last sort of decade plus, you've got Global Reporting Initiative (GRI), Sustainability Standards Board (SASB). You've got the Sustainable Development Goals. You have the Carbon Disclosure Project, and then the hardest acronym of all is the Task Force on Climate-Related Financial Disclosures (TCFD). All of these standards are all moving in the same direction, but they're covering different territory. And what we see is that there's a certain amount of thematic coverage for different standards for different corporate sectors. So for example, a brand that might be more consumer-facing, we often find that they will probably be engaging with the CDP for disclosures. For financials, you certainly see that there's more of a focus on TCFD. When you talk to investors, and I'm sure we'll touch on this as well, ultimately investors are looking for reliable data. And I think generally speaking, I don't think it matters that much which platform or platforms a corporate uses. But the most important thing is to begin to develop an internal framework that can reliably track and generate and share data in a way that, as was said earlier, can lead to corporates making better decisions and identifying risk more soon. and providing data in a way that investors can begin to make asset allocation decisions too.
Thank you, Sebastian. Michaela, let's come straight to you and ask how, from an investor point of view, first of all, what's demand like? Is there demand for sort of high performance ESG practices when you're looking at the investment market? But secondly, and building on what Hannah and Sebastian were just talking about, what tools do you use to evaluate what corporates are saying, what investment targets are saying in this area?
Well, that's a question which you need to answer in two different ways, right? So the one thing is because we talk about different investor backgrounds. So if you look at institutional investors, I think Sebastian laid it out quite nicely. There is it's not only a reputational risk for the issuer, for the equity or debt issuing entity itself, right? What they report, but it's also from an institutional investor point of view. When you're an asset manager, also reputational risk, right? So you have to make sure that whatever you report or what you look at the data, that this is aligned. I mean, the biggest problem we have actually in the institutional environment, but also obviously leaning over into my global wealth management environment, is the data comparability. So, and again, Sebastian laid it out, because there's different kind of institutions out there, standards, practices, everywhere has a different way to report things, and the data are not entirely comparable, so that's obviously an issue. But when we look at basically my environment, coming back to my wealth management environment, where we deal with what we call retail clients, so private investors, so we see more and more and steadily increasing demand for sustainable investing solutions, and particularly the triggers for this has been partly also now the COVID pandemic, right? Because this has absolutely accelerated this trend. So we all might have found this period very strenuous, and one way or the other made us take a breather and review where we stand in life, right? So, and also our investors did this, and you start thinking about your finances, in particular also maybe your investments, because you have a legacy, you want to hand on money to the next generation, etc. So how we look at this is basically from a retail investor point of view is, yes, reporting is important. You want to understand what it is, but it's three-dimensional, right, return and aspects investors look at. So the one is you want to have a financial return because you need that, because you need to grow your private investments, right, either as a pension or as an income stream, etc. But you also want to have a societal return. And again, Sebastian mentioned it, the 17 Sustainable Development Goals. So the solutions we provide or we're working on are all targeted to contribute to that. And people more and more realize that this is important. So a lot of the investment solutions will give you tools to see how your investments contribute to the Sustainable Development Goals. Because just pulling out a figure and saying you had so much of CO2 savings or water savings might not put it into context, but if you can put it into context of the Sustainable Development Goals, that makes it a bit easier. And then last but not least, it's for our private investors, it's also important, there has to be a return on personal values. So we see this, that it gains more and more in importance. It's for all generations. It's for the older generations, it's for the younger generations, but particularly also female investors. It's that we have certain kind of values, interests we are concerned about. Is it societal? Is it environmental related? And having insights into how your investments contribute to your values, that is actually quite important for investors as well. And sometimes you cannot put a particular number at it, but you rather have to tell the story around it. And you have to give transparency, for example, how a change process in a corporation took place. And there was the example early on of the energy company in the US. This is what investors our private investors are more interested in. It's like how, are they doing something? What are they doing? And how does it impact society and the environment?
And Gordon, coming back to you, when we look at how Yorkshire Water takes major corporate decisions, investment decisions, that kind of thing, how central are these ESG considerations to those decisions? Are they the starting point? Is it something that gets factored in along the way, or you get to the end of the decision-taking process and then retrofit the ESG onto it? And related to that, what's the employee expectation in this area? Is it of a very high ESG performance, or do they actually not mind too much about what the company is doing?
Yeah, I think back to all the previous answers, really, because we're increasingly seeing the very true risk and value behind all of these issues. They're absolutely central to decision making, both strategically and increasingly very tactically in very much the day-to-day as well. And partly that's further driven because colleagues are very much kind of keen on this agenda. Increasingly it's recognised in how we recruit, and certainly younger generations are very much more actively considering who they want to work for, or at least they were before COVID. Maybe we haven't got so much choice now, might come on to that later. But and equally other stakeholders, the investor community we've touched on, for us, our customers and regulators very much at the heart of that. All of these drivers are pushing ESG factors, sustainability factors, to be right at the heart of decision making, and it's really through every stage, to answer your question very directly. It's setting the direction and the nature of the priorities that we are focusing on and where we choose to invest in different areas. It's then shaping the nature of those solutions and how we approach things. So as I touched on earlier, really trying to move away from hard engineering solutions in our infrastructure to more nature-based approaches, so you get those multiple benefits. And then equally at the end of the chain, it's increasingly embedded in how we measure our company performance and our executives' performance, and locked in with their remuneration arrangements and our regulatory commitments and even our voluntary commitments. So it's kind of throughout every stage. And then just lastly, really what we've embedded at Yorkshire Water is quite an interesting theory that's helping us bring structure and rigour to this whole process and how we shape decision making with ESG factors. And we've introduced something called the 6 capitals, which are the resources on which we all rely and impact. Just to list, so financial and manufactured capital we're quite used to, and a lot of that fits into kind of traditional ways of accounting, but increasingly natural, social, human and intellectual capital alongside, so that you're taking this really broad view of the risk and the opportunity and the value that we are actually discussing. And we've been on that journey of thinking about the 6 capitals and embedding it throughout our decision making for 5 or so years now. And it's genuinely shaped our strategic direction, our investment choices, and some quite interesting IT software to help us optimise and shape solutions. And equally back to the G of ESG, it's shaping our corporate governance and the KPIs we're monitoring and the board committees and things like that as well. So it's absolutely at the heart.
Thank you very much, Gordon. And the 6 capitals, very interesting way of rationalising how you factor these kinds of considerations into decision taking. Hannah, could I ask you to what extent we're seeing ESG considerations now playing their part, shaping corporate transactions? Is ESG starting to be seen as a significant value driver, either positive where there's a strong verifiable ESG performance, or negative where there's considerable exposure to ESG risk?
It's interesting, and I think probably the picture remains quite mixed depending on where you're looking in terms of the nature of the transaction, the sector, and the parties involved. I think, as Gordon's outlined, there's some businesses are sort of very sophisticated in the way they're approaching these things, some less so. Although we are definitely seeing a direction of travel in terms of how high up the radar it's going to be. And I think, as has been previously commented, sort of the COVID situation demonstrated that strong safety culture, businesses that can demonstrate their resilience can really sort of transform value, and certainly that's going to be what, on a corporate M&A point of view, that's going to be what acquirers are going to be looking for, even more so to the extent they weren't before, and therefore how they're going to focus their sort of due diligence activity when approaching their transactions. I mean, it's obviously the whole area of transactional due diligence around ESG is really sort of growing, and that's helping people sort of spot the opportunities. Again, a bit like as Michaela was outlining, the opportunities for the upside and not just the negatives. And I think as we move more and more rapidly into seeing significant amounts of quantifiable information that will allow sort of comparisons across different industries that can be used constructively for M&A, we're going to see people using that information to demonstrate their attractiveness as a target, or even their sort of attractiveness as an acquirer from an M&A point of view. We're also going to see people thinking, well, actually, is this the right target because perhaps it is or it isn't going to enable us to achieve the synergies we want because we're just not the right fit because of the differences in our ESG approach. Similarly, there might be integration challenges if businesses really aren't the right sort of mix for acquirer and target. So I think more and more those issues, those sort of discussions will come up the agenda, and we'll see those be factored in a lot more across the whole remit of certainly of M&A. In the sort of listed company investor space, I think it's probably got, again, as we've discussed, probably much more significant with the fund's focus on criteria, as Michaela's outlined. I mean, we've already seen funds who look at investment, making sure there's criteria, whether it's diversity on the board. We've also seen very recently in the press issues around modern slavery and sort of significant investors divesting themselves of investments if it doesn't meet their criteria. So certainly very high on the radar there. And then looking, perhaps at a couple of other areas of corporate activity and transactional in particular, you've got the sort of private equity houses where they're real M&A activity drivers, and obviously they're heading rapidly towards sort of sustainability-related disclosure requirements, which is really changing the way that they approach a lot of these issues. And perhaps on the sort of the more general private M&A, I'd probably say where that's historically been lagging a little bit behind. But going back to the point I made earlier, it'll depend on what the destination of those businesses might be. Whether it's a listed PLC looking to be an acquirer or an investment fund that really is putting ESG high up. And people are going to be keener than ever to make sure their businesses are resilient enough to deal with sort of future crises and avoid sort of the shareholder activism. So I think due diligence in this area is really where we're going to start to see impact on transactions.
Thank you very much, Hannah. Sebastian, you mentioned earlier on, and Michaela did too, the Sustainable Development Goals. And I wonder if you could talk a little bit more about the extent to which they provide a framework for both conceiving and evaluating ESG performance. The SDGs were obviously primarily designed for governments, but implementation of them is perhaps falling at least as much to the corporates. And while on that subject, we recently had the World Economic Forum organize ESG into 4 pillars, very much grounded on the Sustainable Development Goals of governance, planet, people, and prosperity. And then we've got the UN Global Compact also running alongside all of this. Just if you can just describe how all this fits together and what its contribution is, that'd be really helpful.
Well, I will do my best. It's really interesting to see how the SDGs have sort of started, at a governmental level, backed by the UN, emerge as really a framework that corporates are now applying themselves. There's something, I guess, somewhat universal about the Sustainable Development Goals that I think really appeals to a lot of corporates and their leadership. I guess on a practical basis, what we have sort of seen is that the SDGs have essentially become a subset of criteria that sit within a corporate ESG process. So I'm going to confuse my acronyms there. And it's quite interesting. Last year, around half of the biggest 250 companies in the world had acknowledged Sustainable Development Goals and actually incorporated them within their reporting. So this is something that's actually very real and very tangible. I guess one of the key themes that we've seen is that typically the companies that engage in this are the larger ones because their reach is global and therefore their stakeholders are global, their impact is global. If you take like a Unilever, for example, when they think about water, they're thinking about water consumption associated with the production of their products. They're thinking about water consumption associated with the use of their products. And you apply that into emerging markets where water it might be in short supply, or where there might be water constraints between the use for corporates and the use for populations. This is a real material. This has real material impact, and you see these global organizations now taking that to heart and incorporating it into their framework so that they can. Well, I think once you identify it and you incorporate it into your processes, that creates the opportunity to monitor and track it. And I think the natural evolution of that becomes, well, at some point we need to put a KPI around it because there's no point just tracking it. And I think it's at that point when companies really think about, well, how are we using this and what does it mean? That's the moment when I think decisions get made, resources get allocated, and impact gets felt. So I think this is a really critical part of the ecosystem, and it's great to even be able to talk about the Sustainable Development Goals within a conversation on ESG.
Thank you very much, Sebastian. Gordon, you mentioned the impact of coronavirus, and I wonder if I could ask you to say a little more about that. To what extent you think that there's been an accelerator effect, that the effect of the lockdown, the community response and so forth has really changed perceptions? Have we all become more socially conscious as a result, or will we just slip back as life gradually normalizes? Will we just slip back to being how we were before? What do you think is happening there?
I think it's definitely accelerated and highlighted an awful lot of issues. I think that you're absolutely right with the pivotal question, really. Is it going to last and which way might we go? I think for me it's certainly highlighted and therefore escalated an awful lot of issues around corporate, economic, social resilience, and all the issues that kind of those in the profession have been grappling with for quite a long time are now rapidly up the priority list for politicians and other decision makers. I think we've really seen for the first time since the Second World War that our way of life is not necessarily as stable and to be as taken for granted as perhaps we have come to over the last few decades, and particularly it's highlighted the inequalities that we have in society. And we've heard a lot on the news about how, I can only think really just how hard it must have been if you're a couple with a young family in a tiny flat in a big city with no green space. Quite how you haven't lost your head in these last few months must be an enormous challenge. And if you're in the gig economy and your whole way of life is now so uncertain and so on, I think it's just highlighted all of those things. And kind of, I think for us in the profession, that gives people like me the ability to then say, well, that's kind of a flavour of what I've been shouting about for 20 years now, and kind of an expectation of what we might expect in 30, 50, 80 years' time if we truly roll forward into deep climate change and what that might bring. So I think it gives us all that insight, which is really useful. But I do think now, though, as I say, we're kind of at a pivotal point, really. There's pros and cons to what's happened. And it's certainly, we've embraced agile, we've embraced digital shopping and home working and all of these things, and reduced our travel, some of those upsides, but equally all our shopping now seems to be back in disposable plastic bags, and we've got loads of disposable plastic PPE, which I keep annoyingly see when I go for my evening walks and all these kind of things. So there's pros and cons. I guess the key thing is, if we roll that forward for years to come, how much of our behaviour change will be locked in. And I guess I'll try to be an optimist, but I think we could go either way here as a society. Do we double down as what we've had and think what we had before was good, and we should try and go back to that, which some of what our government in the UK has pushed is kind of build back, build as a focus, which not necessarily is giving us the right answer? Or do we take the opportunity and this momentum to kind of push forward into a low carbon, more sustainable, more fair economy and build back better? I'm hoping we're swinging to the latter, but I think only time will tell.
Thank you. Michaela, on the environmental side, we've seen the European Council, we've seen the British government putting a major emphasis on an environmental aspect, an environmental dimension to the use of COVID-19 recovery funds. Do you see that as creating new opportunities for investment? Are we likely to see an accelerator in the green economy as a result of all of this?
The short answer is yes, but let me be a bit more precise on that one. So indeed, governments around the world have been boosting investments in green projects to revive economies after the COVID-19 pandemic. And it's not only here in Europe, as you mentioned, in the UK, but it's also, like, for example, China has a program in place as well. And there was actually an analysis in the Wall Street Journal the other day, which calculated that the world's top 50 economies were putting around $583 billion into boosting green efforts. So as such, we expect this really to add further momentum to sustainable investing and supporting already the anyway kind of robust investor interest we are seeing in sustainable opportunities. And this is across equities, credit, and private markets. So maybe just looking a little bit also again in detail at the EU's post-coronavirus recovery package to give a bit more detail there. So there has been actually a research which was conducted by the EU and commissioned by the European Climate Foundation, which identified that there are more than 1,000 green projects which are eligible for funding, and with the potential to support over 2 million jobs, and that would require investments of around 200 billion euros. So yes, indeed, there will be investment opportunities coming up in maybe not the short term, but probably more medium to longer term.
We're reaching the end of what I've certainly found a fascinating and really good broad discussion. I wonder, Hannah, if I could come to you with one last question for this session, which is to ask whether you're optimistic that this is a moment when the needs of society and the liberal market dynamic that we've been used to in this country and in Europe for so many decades will actually start to work in harmony, or do we need to keep putting weight and emphasis on the ESG side of the balance in order to make sure that it doesn't get displaced by pure liberal market economics?
Well, I am by my nature an optimist, but I do think that there's always going to be an element of having to push ESG. I mean, if we strip it right back, what's at the heart of it? It's the corporate social responsibility, and making sure that we're all being good corporate citizens and doing the right thing. And so it's very difficult to see how, whilst it'd be nice to think we've reached that state, how it's not going to be relevant. I think the other thing is just how constant the evolution of the whole area is, and the speed with which the discussion and the focus is going to shift. I mean, I think if you look back 6 months ago, the focus around sort of the E and single-use plastics, climate change. We've moved very quickly in the last couple of months through the S, both with the COVID-19 issues and then diversity and inclusion. Here in the UK, we've seen things to sort of focus on modern slavery, fair pay, workforce conditions, and ESG is always going to be influenced and sort of move with a range of factors depending on what's going on in the wider economy and the political climate. And I suppose sort of feeding back to what Gordon was saying, who knows what we'll be talking about in 6 months' time? Who knows what will be on the agenda? And wouldn't it be nice to think that there's going to be some of these things that we've talked about that are no longer going to be on the agenda, such as modern slavery and diversity. So, we have to continue to use ESG as a way to tackle some of these sort of fundamental issues in business and society. And I think, unless we're going to move to a framework of pure regulation, which I would query whether that can move fast enough and be flexible enough and meet such a broad range of stakeholders' needs, we're going to need to push ESG as an agenda in the way that we've started to do so now. And I think it will continue to develop, and I think it will allow us all, sort of the society, the liberal market dynamic and ESG to work in harmony.
Well, thank you, Hannah, and we're just coming up to the hour, so I'm going to say warm thanks to Gordon, Michaela, Sebastian, and Hannah for what I think has been a very interesting, very in-depth and profound discussion about where ESG is going and how it delivers value in our market economy today. Tony, let me hand back to you.
Thank you, Matthew. So a big thank you to our panelists today, Sebastian, Hannah, Gordon and Michaela, and to our tireless host, Matthew, for a fascinating discussion. I think what's clear from today's discussion is that this overarching principle of sustainable investment is certainly here to stay. It's having a major impact on both big business and society in its broadest sense. It's also clear from some of the comments today that and I've heard this a number of times, that sustainable investment can be a long-term value driver, and that's where it starts to become very, very interesting around that. We'll now be taking a break in August, but we look forward to hosting you again on Thursday, the 3rd of September at the same time, so that's 2 p.m. UK time, 3 p.m. CET, for our next Talk to the Experts, a virtual discussion forum. Thank you, everyone, and enjoy the rest of your day, and wishing you all an excellent summer.